Ever since the Fed's big rate cut in September 18th this year, the mortgage rate has been going nowhere but up. As of now, Friday, November 1st, just a few days before the presidential election, the 30-year fix is at 6.7%, almost three-quarters of percent increase since the Fed's rate cut. Not only that, the U.S. job report has just been released today by the U.S. Bureau of Labor Statistics, and it was the worst job report in recent years, with only 12,000 new jobs being added in October, far less than the 113,000 that they were forecasting, making you wonder what's going on with the economy, what's happening with the mortgage rate, especially after the election. We're going to talk about all this in today's video. Make sure you watch until the end. Hello everybody, this is Bojie He, your Bay Area local real estate expert, and welcome back to my channel. Today, we're diving into something that is super relevant right now, the mortgage rates and how they're being influenced by the upcoming election and various economic factors. If this is your first time watching my channel and you like this type of content, make sure you hit the like and subscribe button for more future videos. And if you're looking to buy or sell real estate here in the Bay Area and have questions, feel free to reach out to me as well. I'm never too busy to answer your question. So let's get right into it. First of all, just a quick heads up. We usually steer clear of politics here unless it really ties into the housing and the rates. And guess what? Right now is one of those times. So what follow is a straightforward look at the situation. No opinion or political bias, just the facts. Let's kick things off by talking about mortgage rates. Honestly, things aren't looking great, and most of the media is stuck on Freddie Mac's outdated weekly survey number. Reality is, weekly average are already much higher than what's being reported. Now, there's a noticeable link between the election buzz and recent interest rate changes. Just because two things are related doesn't mean one causes the other. But some big name investors think a Trump win would lead to a higher rate, especially since it might mean a full Republican control of the Congress and the White House. On one hand, there's definitely some connections there, but on the flip side, it's not a perfect match. Plus, there are other major events happening that could also be influencing interest rates, so it's tricky to predict how rates will react to the election. Take today, November 1st, for example. Rates didn't budge after a weak job report, something that usually make them drop. Sure, there was a quick dip in rates, but it bounced right back almost immediately. This reaction was pretty muted for a job report, hinting that a market has some other things on their mind. And where is that somewhere else? It's not as straightforward as it seems. You might think the lack of response to the job report is just pre-election jitter, but at the same time, Trump's chances were dropping while rates were climbing, totally the opposite of what you would expect. So, what can we say about the bond market sentiment? Here are a few key points. Number one, investors still remember the rate hikes from 2016 to 2018, which likely links to Trump to higher rates in their mind. Number two, many see both parties are potentially bad for rates, since either could lead to more treasury issuance, one of the main reasons rates have shot up post-COVID. Number three, Harris represents stability for most investors, but that doesn't do much to lower rate. Number four, Trump could bring unexpected policy changes, which could go either way for rates. And number five, a single party controlling the government usually means rates go up, as it can lead to revenue shortfalls. Number six, lastly, traders aren't naive enough to think that every campaign promise will become reality. Now, the last point is crucial. The market isn't just waiting to see what happens based on the election result. The recent raise in rates can be due to a mix of the economic data from October, a general unease about financial outlook from both parties, and a typical desire to play it safe before a big event. Now, speaking of that job report, you might wonder why this week's number didn't help rates. The non-farm payrolls came in at a meager 12,000, which is way below expectation. In any other scenarios, this would have sent rates tumbling. So, what gives? Well, as we mentioned, last week, the market was cautious about the payroll count due to weird weather and other temporary factors. This time, the unemployment rate was the key figure and it matched the forecast perfectly. Plus, wages and hourly worked were higher than expected. Not a huge deal, but definitely not good for the rates. And let's be real, traders are hesitant to bet on rates dropping until there is solid proof to back it up. That means we're likely waiting for the election results and possibly for a stream of weaker economic data. After all, if traders had a crystal ball for rate drops after the election, well, we wouldn't be in this situation. So, what's next week looking like? We'll definitely get clearer insights into how much of recent rate pain was driven by politics. Expect a lot of volatility. This could swing either way. So, if you are hoping for rates to drop post election, well, that's a coin toss. What does all that mean if you're planning to buy, sell, or invest in real estate during this uncertain time? If you're looking to buy, keep an eye on the rate trends. While rates are high now, they can fluctuate. Don't hesitate if you find your dream home. Remember the saying, marry the house and date the rate. You can always refinance later if the rate drops, but if you are waiting for the rate drops and then buy, you may find yourself in the bidding war. If you're thinking about selling, now might still be a decent time to list your property. High demand can offset high rates, especially if your home is priced right. Just be realistic about pricing and be ready for negotiations. And if you are investing in real estate, focus on properties that have strong cash flow potentials. Higher rates can impact affordability for buyers, but rental demands often remains strong. Look for opportunities that can weather these changes. Thank you for tuning in. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more updates. See you on the next one.